Hello? Hello, can you guys hear me? Oh, hi, precious. Um, Precious, are you the only one hearing me? Can anyone else hear me? Hello? Can anyone else hear me? Okay, Shukuri, how are you? Alpha. Huh? Okay, Eze. No, today you don't miss class. Today you don't miss. Can you guys see my screen? Okay, okay. So, let me get my screen. Okay, yeah. So, I think this is actually the first lecture we are having seen for quite some time. Well, as you've missed couple of classes, and PC. I don't know if you've attended any class yet. So, yeah. Okay. So, we're supposed to do we're supposed to do um I think first I would like to know if anyone has a question on anything, so that I'll just compile um so I'll just make a compilation of every question that we have, for so that before when I start the class properly, then I will know how to fix the questions into what I'm saying. Okay. So yeah. So you can ask me, please, let's be audible, so that we can hear each other. Yeah. Okay, you can continue. Okay, okay, okay. So are you good on market structure? Okay. So, but are you good on market structure? Like, are you pretty nice now? Like on market structure. Hello, hello, precious. Hello, precious. Okay. Do you have any question that you want to ask? Okay, you don't have any questions. All right. Okay. So I'm going to talk about what Eze said or asked, like the first speaker. So let me use this place as an example, because okay, I'll just leave it here. Okay, so I'm going to start with you're welcome, Mary. You're welcome. I'm going to start with the general overview of market. I'm going to do a general overview of market, before I start answering, or before I answer the question that the first speaker asked. Okay, so we all know that. Okay, I think I wrote on the group today that Forex is like it's like a cult, that when you get there you will kind of be addicted, you understand, something like that. So, and on the group there was I think there's a place I talked about the people that move the market, or how the market works. So that's how the market works. It's not just on cryptos or on Forex or on stocks. You understand? When I said how the market works, I am talking about all the assets, like Forex, cryptos, stocks, commodities like gold, silver, platinum, all these metals, stocks like Tesla, Apple, for all those things, and then Forex like currency pairs, GBP USD, Euro USD, Euro AUD. So these are currency pairs, or like cryptos like Bitcoin, Ethereum. So there are people that move this market. There are institutions that move the market. You understand? Like there are big boys in the market that play the role, that play a very major role in the markets, like in all these industries, both cryptos, Forex, commodities, stocks. You understand? So there are institutions there. You understand? So these institutions are institutions like the banks. Okay? Like the banks, the pension companies, investment banks, corporate companies. So like these big institutions are the people that move the market. You understand? And lots of them. You understand? So in our own part of trading, which is Forex, we deal with the banks. And we deal with the pension companies, but most especially the banks as Forex traders. You understand? So we are Forex traders and we deal with banks. You understand? So these banks, they have people that actually they are the main drivers of liquidity. They provide liquidity to the market. They have the biggest funds in trading in the market. You understand? Because we, the retail traders, we don't even have the capital. I mean, like the liquidity to move markets. You understand? But in some place, or in a kind of way, we, the traders, we also provide liquidity to the market. You understand? We provide liquidity to the market in a way when we lose. Like if you want to take a buy and the market comes to your stop loss and taps you, I mean like takes you out of the market and then goes to your favor, you've lost money. Okay, you've lost money, and automatically you are providing liquidity to the market. You understand? You are automatically providing liquidity to the market, which means you are providing money to the market to move, because it's only money that moves the market. Like it's only liquidity. You can always say that liquidity equals stop losses, or stop losses equals liquidity. You understand? So you can say that stop loss equals liquidity, because when your stop loss, when traders stop losses are triggered, they will lose, then they will provide money to the market. You understand? So a trader is providing money to the market, and the institutions are trading too. You understand? So you can see the it's like a liquidity flow, something like that. So everyone is putting money into the market, then the market moves in a kind of way. You understand? Depending on the trend. You understand? So it is liquidity that moves the market. And the institutions, one thing the institutions does is one thing that the market does is the market or the institutions buy before they sell. I see what you say. I see what you're saying. So institutions buy before they sell. Okay, so they need to, when they want to make a transaction. Okay, you could imagine when a country is giving banks the central banks the money to, like, to stable the economy. These banks, they have some tax for the government. You understand? They have tax to do for the government. They have to stable the economy. They have to make trades. They have to make sure that their currency is strong and competing in the industry. I mean, like in the economic world. You understand? Something like that. So you could see that surely there have to be liquidity in the market. So and the institutions, they, like I said earlier, they buy. If they want to sell, they buy before they sell. And if they want to sell, they buy before they sell. I don't know if I'm making sense. Like, if they want to buy, they will sell. What I mean is that, let's say, because for every buyer there must be a seller in the market. Yeah, and it is just that is just how the economy works. For every buyer there must be a seller. If you go to the market, if you want to buy something, you're buying, and the seller is there with you. So you always have a buyer and you always have a seller. So when the institutions want to buy, by the institutions I mean the banks, just like I've explained. Okay, just like I've explained, like the banks. Remember I said that there are big players in the market. There are big players in the economic market, in the cryptos, in the forex, in the stocks, and in the commodities. You understand? So if they want to buy, they will need to sell. They will need to lure people in. Like, they will need to create orders. Like, if they want to, for example, let's say they want to buy like euro, Australian dollar. You understand? They will need to buy. So to create orders, if they are buying, they are just creating order. You understand? They are just creating orders so that they can sell and then merge. When they are selling, they are merging their orders. These are pending orders. So they are filling the orders. You understand? So that's why they buy before they sell. You understand? That is how they do. That is how they do it. They buy. The reason for them doing this is just to lure people in, so that they can sell. So that they can match their orders. Because for every buyer, they are selling. For every buyer, they are selling. This is the seller. You understand? So this is just how, literally meaning of how the market moves, and then keep moving in trends. Okay, let me just clear this up. And then they keep moving in trends. Okay. So does anyone understand what I said, or does anyone have a question? Okay, so I guess I should continue then. So if you listened carefully to some of the lectures on the course, you will find out that I said the only way for this market, the only way for the market to tell you where it's going, the only way for the market to tell you where it's going is by breaking structures. It has to break structure for the market to tell you where it's going. There is no other place for the market to know. There are no other ways for you, the trader, to know where the market is going unless it is trending. If the market is trending, then that means yes, it is working. It is showing you what it is like. It is just showing you the steps. It is breaking structure to the downside. Then you stopped here. Then it took a high. It did not break here. It went up. It didn't break this structure. It went up. Broke this structure. And then kept going up. Came down, went down. Started making highs. So this is, for example, now this is clear downtrend and a clear reversal to the upside. You understand? So like this is just the only way. This is how the market tells you, okay, this is where I'm going. You can follow me. You understand? Like when it keeps breaking low for a downtrend, and then when it starts breaking high for an uptrend. You understand? So now, and we talked about that for every break of structure, the market pulls back. Like for every break of structure, the market pulls back. For every break of structure, the market pulls back. For example, I'll leave this here so that I will use it for example. So for every break of structure, let me go back to so this is a structure, a break of I'll start with this one. So this is a structure. I'll start with this one. So this is a structure. It broke, then it pulled back. This is a structure. It broke and it pulled back. This is the second structure. It broke and it pulled back. It pulled back. So these pullbacks, as it is trending down, is our supplies. As it broke, it must pull back. That is why your setup, your supply or your demand setup needs to have a break of structure. On the course, I said about the two criteria for a valid setup. It must break structure for you to have a supply or for you to have a demand. That means a setup, then a break of structure. Your setup must break structure for you to have a valid setup. You understand? So if it doesn't break a structure, just leave it. You are not trading. You understand? So because for every break of structure, there must be a pullback. That is how the market works. That is how the market works. And remember, if you're shaking this break of structure, you can also be shaking this break of structure. Sometimes you might not have these ones that are closer to the price. Remember, if you are trading or if you are analyzing our market, we are focusing on the most recent action. We are focusing on the most recent action. If we are analyzing our market, like if we are analyzing from the monthly time frame down to the to our entry time frame, if we are coming down gradually from the higher time frame, from the monthly to the weekly, from the weekly to the daily, from the daily to 4 hour, just like that, we must always, like, as you're coming down, you should be concentrating on the most recent action. And it is from your most recent action that is when you get your support and resistances, your real-time support and resistance. So someone should remind me about real-time support and resistance if I forget, so that I will talk about it. Real-time support and resistance. So I said that for you to have a valid setup, it must break structure. Your setup must break structure. Okay, and if you're analyzing the market from your higher time frame down to the lower time frame, your concentration should be here, the most recent action. So because it is from this most recent action that breaks structure for the market to give you the direction, like for the market to have if you're a trader and you're coming for the day, you should have a directional bias. A directional bias is where you think, based on your analysis, where you think the market will give you, or the setup that you're looking for. If you analyze the market from your monthly time frame down to your entry time frame on 15 minutes or 5 minutes, and you could see that the market is breaking structure to the downside and tapping into supplies and going down, and you reached on your 15 minutes time frame or your 5 minutes time frame, depending on the time frame you are trading, and then you are taking a buy setup, you can see that you're on the wrong side of the market. You're counter trending. You understand? So if your monthly, based on your analysis, before you start trading, it is downwards, if you reach on your entry time frame, make sure that you're having a supply or a supply setup. That is if your higher time frame analysis down is a downtrend, concentrate on that. Just take only supply setup. But if it is in an uptrend and it keeps on breaking highs on from your higher time frame to your lower time frame, that's your daily time, your top-down analysis is bullish. If you reach on your lower time frame for entries, you should also take bullish setups. You shouldn't just you have break of structure to the upside and demands, and you're coming to the lower time frame to take a sell. How do you want to do it? You understand? So if the market, so that's why I say that you should be concentrating here, like if you're analyzing, like getting down to your entry time frames, and make sure that your setup must break structure. This structure was broken by this one. It was this that generated the move that broke structure, and it was this that made the move that broke structure. This green made the move that broke structure. This green made the move, pushed them to break structure. You understand? So now we know that the market is trending down. Remember, we are concentrating on the most recent action. Okay, so it's kept on going. Now we have another structure. This is another structure. Remember, it broke this, it pulled back. It broke this, it pulled back. Remember, which does not break structure. It broke, then it pulled back with a supply. You could see that for each break of structure, there must be a pullback. For each break of structure, there must be a pullback. For each break of structure, there must be a pullback. That is how the market works. For each break of structure, there must be a pullback. For each break of structure, there must be a pullback. For each break of structure, there must be a pullback. If it is going in an uptrend, for each break of structure to the upside, there must be a pullback. For each break of structure to the upside, there must be a pullback. For each break of structure to the upside, there must be a pullback. You understand? So this is the sequence of how the market works. You understand? So with this, you'll be seeing that, okay, this is where the market is taking me to. This is just the setup I'm looking for. I'm looking for sells. I'm looking for supplies. I'm looking for resistances to give me conviction that the market is trending down. You know, like resistance based on where the market is pushing the market down. Do you understand? If the market is creating real-time resistance, you just go in line with the trend. You understand? So, but if it is trending up, you know, like making higher highs and higher lows, you should be looking for break of structure to the upside, then a pullback. Break of structure to the upside, then a pullback. Break of structure to the upside, then a pullback. And remember, before the break of structure, there must have been a setup, then a break of structure. Okay. So that is how the market works, and you keep getting your setups, Okay. So that is for a downtrend. You understand? And you already know it will just be the same thing for an uptrend. Let me look for an uptrend example. So I would give you guys. So let's say we took this break of structure, then a pullback. Break of structure, then a pullback. That is just how break of structure. You could add here too. Break of structure, then a pullback. Break of structure, then a pullback. Break of structure, then a pullback. That is how the market works. It keeps changing trend when it starts making low, when it stops breaking highs. If it stops breaking highs, then the trend probably changed because there was no candle to break this high. It started making lows, then it started breaking structure to the downside. Okay, so that is trend. You know, like that is trend, and this is just basically how the market works. So now, does anyone have question on what I've just done now? Does anyone have question on what I've just done now? Okay, so let's say that everyone is like, it's quite explanatory or self-explanatory. Okay, so I'll put this on so that I could find what I'm about to teach right now. I hope you guys understood this stuff I just talked about. I hope you guys understood it. Okay, now I'm going to talk about liquidity. I'm going to talk about liquidity. It's actually like, how would I put it now? It's likely it's the most, like, my recent style of trading is still supply and demand, but it's just based on liquidity. Hello? Are you guys hearing me? Hello. Okay. Okay. So no one has a question. Okay. So um, I want you guys to know that it is it is liquidity. By liquidity I mean funds. It is money. It is liquidity that moves the financial markets. Like based on my explanation about the banks and everything, you know, it is those funds that they put into the market, both the losing trades, like when a trader trades and loses and adds money to the market, you understand? So it is the money that we are contributing to the market that moves and drives the market. Okay, so I want to give my explanation with a trade. Okay, let's use this one. Let me use this one. Yeah, so I'll use this one for the example that I want to give now. Let's put it. Yeah. Okay. So the market was pushing down, like pushing up, did not break this structure. I can use this structure, I can use anyone. It started trending down, then it was breaking structure to the downside. It was breaking structure to the downside. So I am convinced that the market is going down. Then I have a, let's say, like, something like a demand here, you understand, but I'm not going to draw it. So the market came down. Yes, it tapped into a demand, went up. Then we already know that the market is trending down, it is breaking structure to the downside, and we have a supply here. Okay, so since we have a supply here, let me check and see what happened. I'm going to put this here. Here. This must be, so I think this, I don't want this to be complicated, but after talking about this then if we'll still have a class on this, you understand, because I am trying to explain liquidity. Like I'm trying to explain liquidity. So before I said that we were breaking structure to the downside and the market came down, went up. We have a supply here. But if you look here, I don't know how I'm going to explain this so that you guys would understand it. So or should we fix another class and just stop basically on just liquidity? So that, because this might likely bring a confusion to you guys. I think this should be complicated for you guys to understand at this stage, and we should just stop on the supply that we've talked about, and then talk about this on the next class, because this will be pretty kind of complicated for you guys to understand. But the most important thing right now is that I want to make sure that you guys are understanding supply setups, demand setups. I mean, by having a supply, then a break construction, a supply, then a break construction. You understand? If it is trending up, a demand, then a break construction, a demand, then a break construction, then it is going up. You understand? So I really want you guys to ask me a question on supply or demand or market structure, so that I can explain it. You understand? So I'll on liquidity, I'll talk about liquidity on our next class. You understand? Because this would be very kind of complicated for you guys to understand at this level. You understand? So if anyone has a question, or any confusion, you could tell me so I will explain it right quick. So I don't want to say that silent means consent. So yes. Yeah. You can ask your question. Hello. Yes, you can. Okay, I yes. Okay. Yeah. So how long do you hold your trades? Yes. 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 Perfect. Yeah. Yes. Yes. It does have um so which time frame do you want to trade now? On 1 hour time frames? Yeah. Okay. Yes, you can use 15 minutes. You can use 15 minutes because it's 15 minutes is it's quite clear. Like I used to call it like the um the most sincere time frame. Like it used to be very clear. I love 15 minutes. So yes, 15 minutes you can use 15 minutes for your entries. I trade 15 minutes time frame too. I trade 15 minutes time frame. Yeah, you're welcome. Well, you can also trade on 15 minutes if you want to. Yeah. So do you okay? Hey. Yeah. So you talked about that question you talked about. Um, if you said if you have a demand or a supply on the higher time frame, and on the lower time frame you still have the demand or the supply on the lower time frame, right? Okay. Um, you know that how this market works is that if you look at this time frame, you will see. Are you seeing my screen? Hello. Okay, you move. Okay. If you look at my screen now, you see like it had 1 second. 1 second is like this. 1 second. Okay, let me check on for 1 minute. Okay, I have 1 minute. So this is 1 minute time frame. Yeah, this is 3 minutes time frame. Can you see my whole screen? Can you see where I'm changing it from? Okay, this is 5 minutes time frame. Okay, so and on and on and on and on and on and on into 12 minutes. So now the one second drives the 5 seconds. The 5 seconds drives the 10 seconds. The 10 seconds drives the 15 seconds. The 15 seconds drives the 30 seconds. The 30 seconds drives the 1 minute. The 1 minute drives the 3 minutes. The 3 minute drives the 5 minutes. The 5 minutes drives the 15 minutes. This is so in 4 hours or in 3 hours, something like maybe in 1 hour, you have all this time frame combined together, which forms this 1 hour candle. You understand? So now, if you are trading 1 hour time frame, you for sure you get lower time frame. You get lower time frame supply or demand, which is in the lower time frame, which could be either in the 5 minutes, 15 minutes, 30 minutes, 45 minutes time frame. So there are other lower supply and demand attached under these ones. On 1 hour, you will see all this on 1 hour. On 2 hours, you will see from here down here. You understand? So this is how. So you are surely going to see those type of setups. So when you have or when you get those type of setups, for sometimes it could actually be a gap. Something like you might have something like a supply here, and you still have maybe on 15 minutes you have something maybe around this place, which the market would likely want to tap into, maybe on the 15 minutes or this thing on the lower time frame, which the market want to tap into. You understand? And would like if like for in some instances might drive the market deep down into the zone, and take you out. You understand? Because it wants to touch the lower time frame setup there. You understand? So you can't run away from that. You understand? So the only thing that was why I wanted to talk about liquidity today. But it could be kind of confusing. So by liquidity, I mean by something like this candle, this type of candle, taking out the stop losses that are here. The stop losses that are here. It just went up to take the stop losses that are here. This is equal high, so it has liquidity there. So this candle just came here to take this thing here. It opened here. The candle opened here, went all the way up here. It just went all the way up here just to take the money here. That is just what it did, so that it could sell. You understand? So you could actually add this to this is what I wanted to talk about. I said I'll talk about it on the next next class. You understand? So that I will talk about it in details and in full distance. So this was what I mean. For each time they take the money. I just say this as taking the money. Each time they just take it, they drop really hard. You understand? Because they have the money in their hands. So sometimes if you have those type of setups, you might just want to wait for confirmation based on breaking structure, depending on which trend you want to do. You understand? Depending on which one you want to do. So you might just wait for it to tap in and then break structure to the upside or to the downside, just based on your this thing. You must not take it like that on the 1 hour. maybe you might come to the 45 minutes and just check for a break of structure, so that you'll be convinced that okay, though it has a smaller time frame demand or supply inside it, but it is breaking structure to the top down upside, something like that. So you will know how to place your trade, but you will know that if you're trading on the 1 hour time frame or for 5 minutes, that your risk, which means the money that you're putting to inside the market, like the money you're using to trade, will be your risk will be more. You understand? But if you want to make money, that will be more too. You understand? So that is, you know, that is how it works. So I don't know if I answered your question. Yeah. Yes, there is actually no way of um, mitigating that, because unless you spotted the demand or the setup inside that big zone, then you might try to use a pending order to go and put at that place on that lower time frame. You might use a pending order and put there, and just let it, because sometimes it might tap into your 1 hour zone and then go all the way to your lower time frame zone, and it might touch your stop loss. So why not put your a pending order, if you want, on the lower time frame setup, and then for instance, if the market wants to go down all the way down to that place, it could pick you up, and then you'll be in the trade. So you just know how to do it. It's just like this. Yeah. Alright. So I don't know if anyone has any questions. Okay. So I'm taking it that everyone understood what I said. So no questions anymore. So I'm going to call it a day if no one. All right. I'll fix another class. I'll fix another class sometime, maybe next week. You understand? So see you guys on our next class.